Hello and welcome to Wescott's latest investment and market outlook. I'm Mark McCarron, Wescott's Chief Investment Officer. And today, in addition to the market outlook and the economic perspective we have, we're going to take an historic look at value and growth investing because it's in the news. We read about it every day, and it's a big driver of what's going on in global markets and portfolios. As usual, we're going to start off with a market update through September 25th. We're going to spend a little time looking at what happened during periods of value outperformance and growth outperformance, and then what followed. And then finally, we'll end with our current outlook. So a quick market update through today. The unemployment rate, which is, we're expecting an update in October, obviously, but just looking at the trends, the trend is slowly declining, which is good news. We're approaching 8.4%, which is much lower than many economists expected in the midst of the pandemic. And that's because the economies are beginning to reopen. That's not only here in the US, but globally. More recently, we've gotten some updates from business surveys, both from manufacturing and service industries, and they too show continued expansion, although at a slower pace. While that's positive and relatively good news, the concern really is the second wave of virus infections in Europe and potentially a fear of a second wave in the US are beginning to weigh on markets. We're seeing evidence of that. In just activity and individuals and people's willingness to go out for dinner and travel and other things. So that could be a feature and a factor in market volatility, and we continue to look at that very carefully. And then the other potential risk out there is the uncertainty related to the US presidential election, which is, again, about 2 months away. And markets are going to begin to anticipate what that outcome might be. But before we get into that, let's give a quick update on the markets. September market has been down in absolute terms, and it initially started with a sell-off in technology after a very, very strong period, about 6 months of very strong returns in the technology sector. We're finally seeing a little bit of weakness there. The sell-off is fairly mild. If you look at the S&P 500, down 7.2% so far in March. That brings the year-to-date return to just under 2%. But as we talked about many times before, if you look at a broader measure of what this market is, again, not focusing on the top 5 or 10 names, but a broad equal weight allocation to the 500 stocks in the S&P, we're down about 5.4% in September, and actually down 7.6% when you look at that index measured this way. And then, as we typically do, we break down the drivers of that market return. And it's pretty clear that on a year-to-date basis, growth stocks, again, the technology and some healthcare, continue to be the driving force, up 19%. And now everything else outside of that sector of the market is at or below where it started the year, which I think is an important factor to highlight. While the averages are up, it's a narrow market. We've talked about that before. The concerns over the virus resurgence in Europe are part of what's happening in the markets, but valuation has also become a concern for some investors, and particularly in the well-loved tech sector. We actually, despite the fact that virus resurgence is happening in Europe, we're seeing international markets holding up relatively well and providing a nice diversification so far in September. And just as a reminder, as we did last time, Wescott's portfolios are less concentrated than the market. We're not overexposed to technology. We have a broader allocation, and that we believe provides a smoother ride over time. So with this market being so dominated by growth stocks, we wanted to take another closer look, and this time a historical look, at what's really the relationship between growth stocks and value stocks. So what you're looking here is a graph that shows the ACW value versus growth, all that means is all country world value versus all country world growth. And that's another word for saying global value stocks versus global growth stocks. This is a chart provided by Bank Credit Analyst, our research firm we use. And the way to read this chart is if you look at key value characteristics like price to book, price to earnings, and dividend yield, and you add those all up and average them all up for the value stocks globally, and you compare those characteristics to those of the growth index and subtract the two, you'll see a very wide margin. In fact, the last point of measurement, growth stocks are trading much more expensive than value stocks, or vice versa. The other way to look at it, value stocks have never traded as cheaply as they are today, which is saying something, because in the late 1990s, during the dot-com boom, that was a period of time where growth stocks outperformed value stocks, and growth stocks became very expensive relative to value stocks. But actually, it's even wider today. So I think what's really important about this chart is that value stocks, which are part of the portfolios we build for Wescott clients, are trading historically cheap. And for on the statistics side, it's 3 standard deviations away from average. So what that means is the average relationship is here, and it's 3 standard deviations away. So that, in the statistics world, is a very big deviation and offers a pretty interesting opportunity going forward in our view. In fact, the other thing I would mention is that this is not a feature just it's not a feature just for the last year, but value has been getting cheaper relative to growth really since 2015. And so what we are seeing is a continued trend and an accelerating trend of investor preference, really, for growth stocks over value stocks, which has made value stocks going forward pretty attractive from a return expectation standpoint. So let's take a look at what happened the last time growth stocks outperformed value stocks and were becoming expensive. The chart here is really showing a relationship between U.S. growth stocks versus U.S. value stocks. And the chart just shows as the line is above zero, in this case 34%, 34.5%, that was the difference in return between growth stocks and value stocks in the late 1990s. That was during the dot-com bubble. And we highlight that because that was the last time, other than today, where growth stocks had outperformed value stocks by such a large margin. And today, the preference of investors is really looking at the current environment, the pandemic-related situation that we're all in. And technology is an investment that many people are making today and comfortable today. But at some point, whether this differentiation continues or maintains for a couple more months, quarters, or years, it's hard to tell. But what happened at the end of 1999 is that once that investor sentiment and once that market leadership shifted, it shifted very, very quickly. And this indicates the underperformance of growth versus value. And on a trailing 12-month basis, all the way back to 2008, value stocks started to outperform growth. And that was really an important feature in really looking at balanced portfolios, ensuring you're not too exposed to what's working today, but prepared for what's happening tomorrow. What's going on today, though, is that the Federal Reserve policy, which is very low interest rates, are supporting those valuations. You might have heard this acronym in the news, but there is no alternative, or TINA, is basically suggesting that there are very limited other options of investments that are going to give you return and dividend. And so the preference for investors to go into growth stocks today continues to be widely supported. However, there could be some catalysts out there that could lead to a shift in market leadership. And those catalysts could be, for example, the vaccine, which could allow us to go back to somewhat of a normal environment and improve the relative performance. The second is that valuations are very, very attractive in parts of the market, and bargain hunters may be coming in to find opportunity there. The other point is regulatory scrutiny. So this week we heard from the Department of Justice to look at what limitations or what expectations are being put on technology and social media companies to be accountable for what's on their websites and what's on their platform. Those things are risks to the current leadership in technology and could potentially lead to a shift in market leadership. Again, global growth could accelerate, and we are seeing evidence of that in China and in Europe. The dollar could weaken from where it is today. That could also be a catalyst for a shift in market leadership. What's really supporting valuations today is very, very low interest rates. It's hard to see them go much lower. So again, at some point, that could be a shift in market leadership. And then finally, a rise in inflation, which is really what the Federal Reserve is trying to manufacture, trying to create with their low interest rate environment. And that by itself could be a shift in market leadership. So all of that said, there are lots of reasons for why the market's behaving the way it is today. And these are some of the catalysts that we're looking at very carefully to determine whether there'll be a shift in this market leadership going forward. So with that, we'll end with our current outlook. The conditions in the economy continue to improve, albeit a little slower than many would hope. The equity market strength, even through September, remains concentrated in growth stocks, but valuations, as we discussed, are getting stretched. And the recent sell-off we've seen in September suggests that maybe market leadership, as we talked about, could be changing. However, we continue to expect a U-shaped recovery, economic recovery, that should result in a broader market with some of those economically sensitive sectors participating going forward. So as usual, we thank you for your interest. Thank you for joining us and your trust in Wescott. Please do not hesitate to reach out to me or your advisor if you have any questions. Thank you.